When it comes to investing, you don't need to have 15 different ETFs in order to have a solid portfolio. Less is more is especially true when it comes to choosing ETFs. And in this video, I'll be showing you with just 2 funds, you can have diversification and growth to help you reach your retirement goals and to build long-term wealth without overcomplicating things. So let's get right to it. To kick it off, this first 2 ETF portfolio is going to be a broad market ETF along with a growth ETF. If you don't already know, broad market ETFs hold a diversified basket of stocks from a variety of industries, sectors, countries, or even market caps. They do this by tracking a large index, for example, such as the S&P 500 index, which contains the largest 500 companies in the US. The great diversification that these type of funds offer is what makes them a great choice for laying the foundation for a portfolio. By having different stocks that are spread over different sectors and industries, lowers your risk, since if one part of the market is taking a hit, the other sectors or holdings can help balance it out. Another great benefit of these type of funds is that they have a strong historical track record. The S&P 500, for example, provided some solid, consistent, and reliable returns over many years through the good and rough times in the market. Some examples of some great broad market ETFs include Vanguard's S&P 500 ETF VU, which tracks the S&P 500, Vanguard's Total Stock Market ETF, VTI, which holds all the stocks in the US stock market, and Vanguard's Total World Index Fund ETF, VT, which holds US and international stocks. Also, here's a list of some other broad market ETFs that you can come back and take a look at later. Now, the second piece to this portfolio is a growth ETF, and the purpose of adding this ETF is to optimize your potential returns. Growth ETFs hold stocks that have the potential for above average growth, which are companies that are rapidly growing their revenues and expanding their businesses. These companies are primarily in sectors such as technology, communication, healthcare, and consumer discretionary. And looking over the past years, you can see when compared to a broad market ETF like VU in the orange here, growth funds have given some really great returns. Now, while growth ETFs can be rewarding, they are more volatile and carry more risk, which can be better for investors with a longer time horizon or a higher tolerance for risk. Here's a list of a few different growth ETFs that you can pause and check out later on. So now let's get into an example and talk about the pros and cons. Here's an example of a 2-fund portfolio with these 2 ETFs combined. We have VU, an S&P 500 ETF, and SHD, the Schwab US Large Cap Growth ETF, making up a 70-30 split. Our broad market fund is going to be the majority here due to its key features of being broadly diversified with a variety of holdings, and it gives you exposure to both value and growth stocks. This combo gives you the opportunity for more capital appreciation with larger potential returns from that added exposure that you get from growth, which you can see here how SHG has performed over these past few years compared to our S&P 500 fund VU. But this does come with a trade-off. It's important to note that many of those growth companies that you have in your broad market fund are also going to be in your growth ETF. Like in this case, SHG and VU have an overlap weight of 53% with around 122 of the same holdings. With all of SHG's top holdings being in VU, you're essentially doubling down on those big tech companies along with a few others. For this reason, you'll be exposed to a bit more volatility, and this impact will depend on how much that you decide to allocate here. And for those who would like even more diversification, instead of having a S&P 500 fund, you could swap in a total US stock market fund so that you have more exposure to more stocks, or for those who must have international, you could grab a total world fund like VT so that you have US and international stocks, which then you could pair with a growth fund. This next 2-fund portfolio is a combination of a dividend ETF along with a broad market ETF. A dividend ETF holds a variety of different stocks that pay dividends, which is a portion of a company's profits that are then paid out to shareholders. Dividend ETFs can provide you with some really nice consistent income regardless if the market is doing good or bad, making this a big plus for those that are looking for an additional income stream, whether that's to cover some of your bills or if you're planning to live off dividends for your retirement. They're also less volatile than some of the other funds like growth ETFs and even broad market ETFs. This is because many dividend-paying companies are going to be more mature and established companies that have a history of stable cash flow and strong financials. This, coupled with the fact that these ETFs also offer the opportunity for great capital appreciation, make them appealing for many investors. Some of my favorite dividend ETFs include SCHD, the Charles Schwab US Dividend Equity ETF, with companies that offer high-quality dividends and dividend growth. DGROW, the iShares Core Dividend Growth ETF, focusing on companies growing their dividends, and then VYM, the Vanguard High Dividend Yield ETF, which is focused on high-yielding companies. Here's a list of a few different dividend ETFs that you can pause and take a look at later on. Now, let's jump over to an example of this 2 ETF portfolio. We're going to have VU as our broad market ETF here and an SCHD, the Charles Schwab US Dividend ETF, for a 75-25 split. Now, depending on your age, investing goals, and strategy, these percentages can vary by quite a bit. For someone that's looking for more dividends and stability, you may prefer to bump up the amount of SCHD here by a lot more. For someone that's younger, that's focused on more growth and wants to slowly build up their dividend portion over time, they may instead put more towards VU, like 80 or 90%. As I mentioned before, your broad market fund in this portfolio is giving you a wide variety of US companies from different industries and sectors, which includes both value and growth stocks. When it comes to the overlap between these funds, it's only 8% by weight, so by adding a dividend fund like SCHD, which complements well, you're getting even more diversification with the added exposure of those value stocks. This adds some more stability to the portfolio. Unlike what we saw with the growth ETF, you're not doubling down on those top holdings that you already have in VU. This is the case for SCHD, but keep in mind here that there are dividend funds that have much more of a growth mix in them, such as DGROW, which would have much more overlap in this case. Dividend ETFs are not all the same. Good news is, while dividend ETFs can be a safer play, they have the potential for capital appreciation, so this portfolio can still give you solid returns. And the main benefit to this setup is going to be the obvious one, which is dividend income. Your dividend ETF is going to be the main driver here for dividend income, but that broad market ETF will also provide dividends too because of the variety of holdings it has. And depending on the ETF, it could range from 1.2 to 1.8 or so, which is definitely better than nothing. No portfolio is perfect, and while there are many benefits to the setup, there are some minor downsides. First being that while dividend ETFs do have the potential for capital appreciation, they're not going to outperform the overall market, such as the S&P 500, or provide outsized returns like growth ETFs. So if you have a long investing time horizon and you're willing to take on more risk, then these type of ETFs may not fit your needs. The second downside someone could point out is that this portfolio may not be diversified enough. One could argue that both of these funds are only focused primarily on large cap US companies, which you'd be right. Instead of VU, you could have a fund with US stocks and international to pair with this, or it might be a better idea to have a 3-fund setup so you have more flexibility in your holdings to further diversify. Next up on the list of 2 ETF portfolios is going to be a combination of a small cap ETF with a broad market ETF. Small cap ETFs are funds that hold small cap stocks, which are companies that have market values between $250 million to $2 billion. Since these are smaller companies, they have much more room for growth and they can provide bigger returns than large cap stocks. With that being said, these funds are much more volatile. While the growth potential can be a big plus for these funds, they can go down just as fast as they go up. And you have much more risk on the downside when the market is in a slump. With all things considered, having exposure to small cap stocks can further diversify your portfolio. Here's a list of some small cap ETFs that you can come back and take a look at later on. Now, for an example of this portfolio, for a small cap, we have AVUV, the Advantis US Small Cap Value ETF, and then VU for our broad market fund with an allocation of 85 and 15. The key feature of this combination is for the added diversification. And the best part is that there's 0% overlap in the holdings between these 2 funds, VU and AVUV, which makes for a great mix. And the reason for this is since VU holds the largest 500 companies, there are no small caps in this ETF, so the addition of a fund like AVUV can fill in the gaps and provide more diversification and add the potential for more capital appreciation. For those who may only want to stick with US funds, I think this can be a good way to further diversify a portfolio. Even if you were to use a total US stock market fund like VTI, the percentage of holdings in small caps are still extremely small, and the addition of a small cap fund would boost the allocations in those holdings. And while I think that diversification and opportunity for appreciation here can be great, it's also important to consider the volatility and risk that small caps can carry. For that reason, I believe a smaller allocation here is sufficient, nothing big like a 50-50 split, for example, but as always, it's up to you to decide what you're comfortable with. Now, if 2 ETFs seems like it limits you in terms of diversification, then you should take a look at this video here where I go into a variety of 3 ETF portfolios based on different strategies. If you made it this far, I really appreciate you watching. Don't forget to like and subscribe if you enjoyed the video, and I'll be catching you on the next one.